Today, credit's last hurrah. Hello again, it's Martin North from Digital Finance Analytics, web-based posts covering finance and property news with a distinctively Australian flavour. Well, of course, here we are again, the end of another month, and so today I'm going to discuss the latest credit stats. That's the data that comes out from both APRA and the RBA on the last working day of each month. And my conclusion is, before we get started, that we are seeing very, very late in the cycle a bit of a boom, driven by business actually, mostly for working capital, but the underlying trend is weaker. So we'll go through those data points in a bit more detail now. And it's worth just saying, of course, that this is based on the publicly available information from those two organisations, and I've done a bit of modelling over the top, but essentially they start to sell a bit of a picture. Now, I'll also say that today I'm going to start with APRA first because there are a few interesting tweaks this month. So, with APRA, we start with the monthly authorised deposit-taking institution statistics, so that's all the banks essentially, and that information is, of course, until the end of June 2022. So the first thing we're going to look at is the change of credit for housing over the month. And owner occupation rose 0.78%, so that was up from last month. And investment lending was at 0.73%, again slightly stronger than last month. And so total credit growth was 0.77%, which is quite strong, but not as strong as it was back in 2021. Now, if we look at the individual story with regards to loan stock, the first point to make is that we've now gone over $2 trillion for bank lending for mortgages, which is ridiculous. It's so high. Within that, you can see there's been growth in owner-occupied lending and also investment lending, but not quite as fast. As a result of that, the proportion of lending in stock terms for investment purposes dropped again. It's now 33.09%. But that, of course, is still high by international standards. I remember when the Bank of England was worrying when it got to 16% of mortgage lending for investment purposes over there, and they were starting to panic. Now, it's also worth looking at the selected portfolio movements between May and June, and there were a number of significant changes. The most significant of all, though, is the massive growth in National Australia Bank's balance. That was because, of course, they amalgamated the Citigroup balances for own occupation and investment. Volt Bank, of course, disappeared as well. Other than that, you can see that Westpac and CBA were the leaders. Then Macquarie. Macquarie is still doing the largest proportion of investment lending, then Suncorp and ANZ. And of course, if the Suncorp merger gets taken on, Suncorp will disappear ultimately too. So now we will look at the RBA financial aggregates, which is the top level information. And just to start with, if we look at the monthly movement in June, it was 0.9% total credit. That's the same as May. And housing credit was the same at 0.6%. Personal credit dropped slightly, down 0.4%, compared with up 0.1% last month. And business credit was up strongly, 1.5%. It was 1.4% last month. And broad money was up slightly at 1%. In annual terms, total credit grew 9.1% over the year, compared with 3.1% a year earlier. Housing credit was up 3.8%, compared with 5.3%. Personal credit was still down, still falling, down 2.7%, but that's not such a big fall. It was minus 6.4% last year. But business credit is very strong, up 13.2%, compared with 0.5%. But I do want to underscore that business credit is predominantly to do with working capital because businesses are finding it hard to get their bills paid. Broad money was strongly up 10% compared with 7.7% a year ago. Now, if we look at the individual data points, you can see that the monthly aggregates for June shows that housing was at 0.61%, pretty much no change from last month. Owner occupation was 0.58%. Investment was 0.62%, so slightly stronger. Personal credit was down 0.35%. and business was up 1.54%. Now, these are very volatile series, the monthly, but nevertheless, you get a good sense that really it's business credit that's driving the momentum at the moment. And if we look at the aggregate levels, all credit grew 0.87% over the month, and the broad money was 0.98% higher. If we look at the annualized series, that takes out some of the lumps and bumps. Housing grew at 7.85%. Owner occupation made up 8.59% of that, whereas investment was just 6.39%. So investment is still lagging, but it's beginning to catch up. Personal credit was down 2.67% over the last year, and business lending was up 13.21% over the last year. Let's look at the credit aggregate for the year. All credit was up 9.11%. Broad money was up 9.96%. And finally, we can look at the 3-month view. Housing grew 1.83%, so you can see it's just easing back slightly. Owner occupation was at 1.83%, and investment was at 1.83% as well over the 3 months. Personal credit was down 0.03, so pretty much flat. And business was up 4.5% over the last quarter. So what you can see here is that a lot of the momentum now is in the business sector. Housing credit is really beginning to, I think, ease down. And I think we're going to see more of this because now what we're going to find is that momentum in mortgage lending will ease. There will be more refinancing, of course, as people try to find cheaper loans. But nevertheless, the momentum is going to come out of the market now. And I wouldn't be surprised to see a considerable fall in the 3 to 6 months ahead, unless, of course, the RBA turns turtle and starts cutting rates again. But that is a conversation for another day. So the bottom line is this. We are in the late cycle bloom of credit. It's going to ease, and all bets are off, I think, as to what happens next. I wouldn't be surprised to see considerable falls. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.